The stock market will crash. It has happened time and time again, and it will happen again. But the crash doesn't have to be a bad thing. Prepared investors turn chaos into opportunity. I've invested for more than 35 years. Through every crash, I came out the other side wealthier than before. Today I'll share the strategies that helped me make millions through multiple market crashes. Understand these signals, and you can spot a crash coming and use it to your advantage. So how common is a market crash? There are 3 different types of market decline. First, the most common, a market correction. That's at least a 10% drop from a recent high. Think of it as the market realizing it's getting expensive and trimming prices back. Since 1980, corrections have happened on average every 1.2 years. They're a normal part of investing. The second type is a bear market. You know you're in one when prices fall more than 20%. Since 1932, bear markets show up roughly every 4 years and 8 months, lasting about 9.6 months. That sounds long, but remember, bull markets usually last around 2.6 years, far longer. The third type is a stock market collapse, an over 30% drop, often in a very short time. These are rare, but they can happen. The market reacts violently to sudden shocks. The takeaway, if you aren't ready for the market to fall sometimes, you shouldn't be in stocks. So how do you spot a crash? Let's break down the 3 phases every crash moves through. I'm not a financial advisor, and this isn't financial advice. I'm sharing what's worked for me. Phase 1. Euphoria. The market peaks, and irrational excitement pushes prices to unsustainable levels. Everyone is happy and flying high. When I see that blind joy, I start preparing for the fall. Before 2008, I noticed booming consumer spending. Everyone had money and was spending thousands. A more recent example, the NFT craze. People paying millions for JPEG files. A clear sign of too much money in circulation. The second 2008 warning sign. Easy credit. People were buying and refinancing homes like never before. Noticing the clues is one thing. Taking action is another. I prepared while the crowd celebrated. My friends thought I was a coward. They didn't understand how much risk they were really taking. If your senses start tingling, here's how to prepare. First, evaluate and minimize your risk wherever possible. I don't chase crazy returns. I want reasonable, consistent gains so my money compounds. Think of the tortoise and the hare. Slow and steady really does win the wealth race. If you've never seen a crash, picture your portfolio halved and deep in the red. Could you hold without selling? Second, reduce your leverage. It accelerates wealth, but it can also be very dangerous. If a stock falls too far, a margin call forces a sale at the bottom to cover your debt. I never use margin. I've watched friends go from millionaire to broke in a blink. Third, save extra cash in a high-interest account, even more than your emergency fund. When everyone suddenly gets comfortable investing, that's often a sign the bubble is about to pop. At the first crack, inexperienced investors panic sell, driving prices into a spiral of doom. Finally, diversify. Spread your investments so you never have all your eggs in one basket. You never know which sector gets hit hardest, so spreading out is your best defense. Say you have $1,000, put it all in one stock, and a crash there crushes your money. A total US stock market fund spreads that same money across thousands of companies and industries. Nobody can predict the market, but diversification meaningfully reduces your risk. A high-yield cash account is another way to diversify while guaranteeing a return. Picture $5,000 saved with $250 added monthly. In 5 years, over $3,400 earned at 5.1% compounding daily. Zero fees, daily compounding, and the freedom to invest in thousands of stocks and ETFs. The crowd called me cautious. From where I stood, they were the ones gambling everything. So when your instincts start whispering, here's the first move. Cut your risk wherever you can. I never chase the wildest returns. I chase steady gains that compound year after year. Remember the tortoise and the hare? In wealth, slow and steady genuinely wins the race. If you've never lived through a crash, picture your portfolio cut in half. Could you hold without selling? Next, reduce your leverage. Borrowed money speeds you up, but it can wipe you out just as fast. Drop too far and a margin call hits. The broker can sell your stocks at the very bottom. I've watched friends go from millionaires to broke in a blink. That's why I never touch margin. Third, stack extra cash in a high-interest savings account. Dry powder for the storm ahead. In 2008, I looked foolish sitting in cash, but I saw the bubble inflating in plain sight. When everyone suddenly loves investing, that comfort is the warning. Prices are propped up by the inexperienced. At the first scare, they panic sell. That stampede drives prices down into a spiral of doom. Finally, diversify. Spread your money so no single collapse can take you down. You never know which sector gets hit hardest. That's the whole point of not betting it all on one. In good times, people pile everything into one winner. It feels smart until it isn't. Say you have $1,000. Pour it all into Tesla and pray. or spread it wide. A total US stock market fund spreads that same money across thousands of companies and many industries. Nobody can predict the market's next move, but diversifying quietly stacks the odds in your favor. There's also the high-yield cash account, diversification with a guaranteed return on every dollar. Put aside $5,000, add $250 a month, and in 5 years you've earned $3,493. That's 5.1% interest compounding daily, with no risky bet required. Public offers this account with zero fees, plus thousands of stocks and ETFs at very low cost. Sign up, fund your account, and they'll hand you a free stock worth up to $300. Deposit $20 or more, and enter code MARK2024 in the Rewards Hub. Links in the description. Now phase 2, I call it the reckoning, where the market punches everyone square in the face. Reality sets in, overvaluation cracks, panic erupts, and the selling becomes a flood. In this phase, the market simply tumbles. It's nearly impossible to stay untouched. In 2008, even my 10-year-old son sensed it. My store traffic halved overnight, but my warehouses were full of owned stock. That inventory became my safety blanket. That year, dollar stores popped up everywhere. Cheap demand meeting the supply of failing businesses. You can read every sign and still get tested here. Phase 2 is pure psychology. Everyone's a long-term investor until the crash. It's easy to be brave while everything climbs. To hold firm, you must know why you bought, understand the fundamentals before you ever invest. Peter Lynch bought Kaiser Industries as it crashed. Zero debt meant bankruptcy was unlikely. It kept dropping under $10. He held his nerve and it eventually rebounded to $50. If you don't understand the company, you'll sell at the bottom and miss the whole recovery. This applies to index investors too. Fidelity ran the numbers and they're staggering. $10,000 in the S&P 500 from 1980 to 2022 became $1,082,009. Miss just the 5 best trading days and you're left with only $671,051. Miss the 50 best days and that million collapses to just $76,104. You think you're timing the market. In the long run, you're only robbing your own profits. Believing long-term is more than holding. In 2008, I saw bargains where others saw ruin. I noticed that 4 years after the 2008 crisis, just after the London Olympics, things started to improve. Businesses were hiring and money was a bit easier to come by. But even though people started to have cash again, the mentality of not spending carried through for a while. So it was another 4 years really, until everything was back to normal. I've experienced a lot of crashes. I'm talking Black Monday, the dot-com bubble, the 2008 financial crisis, and the 2020 pandemic. One of the key lessons I took from all of this was that the bull market almost always follows a bear market. The seeds of your fortune are often sown in times of crisis and uncertainty. As long as you're able to handle your level of risk and you're buying into the stock market consistently with a diversified portfolio, then you stand a much better chance than most of making some real money. If you want me to walk you through exactly how to start investing in the stock market, then I'm gonna leave that video right up there. But don't click on it just yet. Make sure to subscribe if you want to grow your wealth, okay? I'll see you over there. Now let's dive deeper into the euphoria phase and what you should do when the market is at its peak. During the euphoria phase, irrational excitement drives prices to unsustainable levels. Everyone is happy and flying high, but that's when I start preparing for the crash. Before the 2008 financial crisis, I noticed booming consumer spending. Everyone had money, they were spending thousands, and the economy was thriving, but it felt too good to be true. A more recent example is the NFT craze a couple of years ago. Never in a million years would I have thought people would buy JPEG images for millions. Things like this are a clear sign of too much money in circulation. The second thing I noticed in 2008 was the increase in people buying houses or refinancing. It was easier than ever to get credit as the housing market was booming. If people couldn't pay their mortgages, banks could take back properties without losing money. Now it's one thing noticing these clues, but another thing actually taking action. Between 2007 and 2008, I could have just gone along with the crowd, but instead I prepared for the worst. At the time, lots of my friends didn't understand the decisions I was making. They may have seen me as a bit of a coward, but I knew they didn't understand the risk they were taking. So, if your spidey senses start tingling, here's what you can do to prepare. First, evaluate and minimize your risk level wherever possible. Personally, I'm not focused on chasing crazy high returns, as that's unsustainable for the long term. I just want to be making reasonable gains consistently, so my money compounds. I always think about the story of the tortoise and the hare. slow and steady does win the race. If you're new to investing, you might not have experienced a real market crash. It can be horrifying to see your portfolio completely halved in value. You have to ask yourself if you could mentally handle this kind of drop without selling. Secondly, start reducing your leverage. Leverage can accelerate wealth, but is very dangerous. If a stock crashes too far, your platform may issue a margin call. You have limited time to pay off debts, or they may sell your stocks at the bottom. If you're using margin, I'd advise paying some of this debt off. I never use margin, but that's a personal choice. I'm missing out on some potential profits. I've seen too many friends go from millionaire to broke in a blink of an eye. Now I just stay well clear of it. Thirdly, start saving some extra cash in a high-interest savings account. I know I bang on about having an emergency fund of 3 to 5 months of expenses, but I'm talking about saving even more. I did this between 2007 and 2008. It looked strange leaving money in the bank while the market boomed. The market began to recover, rising from the ashes of the crash. It usually pushes above and beyond the last market highs. 4 years after the 2008 crisis, just after the London Olympics, things started to improve. Businesses were hiring, and money was a bit easier to come by. But the mentality of not spending carried through for a while. It was another 4 years until everything was back to normal. I've experienced a lot of crashes: Black Monday, the dot-com bubble, 2008, and the pandemic. One key lesson: a bull market almost always follows a bear market. The seeds of your fortune are often sown in times of crisis. As long as you handle your risk and buy consistently with a diversified portfolio, you stand a much better chance. If you want me to walk you through exactly how to start investing, I've got a video for you. But don't click on it just yet. Make sure to subscribe if you want to grow your wealth. I'll see you over there. Remember, slow and steady wins the race. Compounding is your best friend. Stay disciplined through the chaos. The market will test your nerve, but those who hold on are rewarded. Every crash is an opportunity in disguise. Build your emergency fund first, then invest with confidence. You have the knowledge now. Go make your millions.